Now, I think it's time for us to move on to the second paper. So the second paper is about smartphone investing. Ankit Kalda from Indiana University is going to present.
Thanks a lot. Thank you for including our paper in the program. It's a pleasure to be here to talk about this work. This is joint work with Benny Loos at Technical University of Munich, Alessandro Previtero, who's my colleague and also in the panel tonight or this morning, depending on whichever part of the world you are at, and Andreas Hackethal, who's at Goethe University. So the paper is about smartphone investing, as the title would suggest. But what we are trying to address and what we're trying to get at is really this broader question of the effect of new technologies on investment behavior. Right? And of course, this is not a new question, and we are not the first ones to address this. There has been a lot of literature on this that talks about how the introduction of new technologies is associated with a decline in investor portfolio efficiency. Right, and of course, there are some exceptions to it, particularly related to robo-advisors, but by and large, it is well accepted that technologies or introduction of new technologies may lead to a decline in investor portfolio efficiency. If we take a step back and think about where this empirical evidence mostly comes from, it either comes mostly from some comparisons of investor behavior pre and post technology adoption. So essentially, a new technology comes in, and then you're looking at those who have adopted the technology. You're comparing their behavior pre and post to some sort of control group who have not adopted this technology. And of course, there are some exceptions to this rule, where essentially a couple of papers that potentially randomly assign technology to across investors. So based on this evidence, a common interpretation is that new technologies change investor behavior, right? And this is whether it leads to a positive effect or the negative effect on portfolio efficiency. This is broadly accepted that new technologies change investor behavior. But there are two key assumptions that really go into this if we really think about the empirical evidence or the empirics of the existing literature. One is that absent the innovation, so without this new technology, investors would have behaved in the exact same way. Second key assumption is that investors do not substitute across technologies, right? Essentially that they behave similarly across different platforms. So if these two assumptions don't hold, then there could be alternative explanations to similar empirical findings in the literature, right? So for instance, it is possible that investors might be adopting the new technology exactly because they want to change the behavior, or they are doing this exactly to execute a specific subset of their overall trade. So maybe they are adopting a technology perhaps to execute more riskier trades, and then they are using some other technology to execute less risky trades. And so disentangling across these alternatives is important. And why should we care about this? Why is it really important? Because it is possible that these effects that have been documented might be overestimating the effect of technologies, especially if these technologies are fulfilling untapped demand or simply fulfilling selective investor demand, right? And so specifically, why is it important to disentangle these two? Is because policy implications are starkly different. In one case, we are saying essentially that technology is simply helping investors by fulfilling their untapped demand or selective investor demand. In the other one, we are saying that innovation or technology is actually harming them, right? And the current literature, most likely because of lack of data, is not able to disentangle across these alternatives. And so here is where we come in, where we essentially use more granular data that allows us to speak to these alternative mechanisms. So of course, because we want to talk about technology, the specific technology that we'll be focusing is going to be smartphones, which these days are one of the most pervasive and one of the most controversial technologies out there. So for instance, if you think about just the US, there are over 250 million smartphones. And in 2021, an average individual spends a whopping 4 hours on average on the smartphone. Right? Given that these are so pervasive, it is important to understand, even if we think of smartphone as a standalone technology, it is important to understand how it affects trading behavior. And of course, there is anecdotal evidence, and I'm sure many of you must have heard or read these anecdotal stories where essentially these Robinhood investors had some devastating results owing to their trading. Right? I do want to be clear that we won't be using Robinhood, but essentially it highlights the fact that it is important to understand how these apps are going to be affecting investors. And we will have something to say about it, even though we are not directly using Robinhood data. So in this paper, essentially what we do is we use trade level data from 2 large German retail banks that introduce mobile trading apps. The advantage of this data is that it allows us to essentially compare trades done by the same investor in the same month, but across different platforms, right? So essentially, we would be comparing the trade that Hong does on his smartphone to a trade that he does on his desktop in the same month, right? So essentially, it allows us to control for all types of selection. Perhaps Hong is a special type of investor. That's why he's using a smartphone, right? So we are able to control for this selection, not just time invariant selection, but time varying selection. So even if the characteristics of the individuals change, they are not going to affect our findings. And so essentially comparing trades, as I said, within the same individual and month, but across different platforms, what we find is that using smartphones, investors are more likely to purchase riskier and more lottery type assets, right? So we, even Cameron talked about some of the gambling preferences, and I think we'll be using some similar proxies as his paper. We also find that when using smartphone, the same investor is more likely to exhibit biases. And the specific biases that we examine are going to be under diversification and the propensity to purchase past winners and losers. Now, of course, as I set up in the beginning of my motivation, that it is possible that these investors are perhaps making different types of trades across different platforms. So it's possible perhaps the same investor is using smartphone to do riskier trades and then using desktop to do less risky trades. And so in that case, this substitution is something that we won't be able to directly capture in our baseline specification. And so in order to capture this, what we do is essentially we look at non-smartphone trades for smartphone users. So essentially, after using smartphone, what we find is that investors trade similarly also on other platforms, right? So if they were moving their riskier trades from one platform to the other, we would have expected to find a negative effect on these other platforms, but instead, we actually find some weak evidence of a positive spillover effect, right? But definitely able to rule out the substitution effects. Next, we look at whether there are any implications for returns. And assuming different holding periods, we find that smartphone purchases, even within the same investor and month, earn lower Sharpe ratios and even lower returns, even though they are riskier trades, but their returns are lower. And finally, we find that there are stronger smartphone effects for relatively inexperienced investors. And this is the implication that we can perhaps use to perhaps speak to Robinhood investors who are likely going to be even more inexperienced than those who are inexperienced within our sample. So it is possible that the results that I'm showing you today are going to be an underestimate of the impact on Robinhood type of investors. All right, so I'll quickly talk about the data and who are the adopters, then show you some of the main evidence, talk about the mechanism, and conclude. So essentially, our data comes from 2 large German retail banks. As I said, it's going to be transaction level data. And this is the primary bank for most customers. So they are essentially executing most of their trading through this bank. We have about 65 million transactions going from 1999 to 2017, but we will be focusing on the years from 2010 to 2017 because these are the years when the smartphone trading app actually existed. So even within our sample, you can see that there is the smartphone penetration is pretty high. So conditional on using smartphones, by 2017, a trader was using a smartphone for 20% of their trades. So clearly, if smartphones have any impact on their trades, then their overall portfolio efficiency is going to get affected because 1/5 of their trades or more than 1/5 of their trades are happening through that platform, right? Next week, before we dive into the results, we look at whether there is a selection or not. And I understand that there are a lot of numbers on this table, but I guess the takeaway that I want to share today is in the bottom of the screen here, where essentially we find that smartphone users are those who have higher trading activity, are relatively more risk-loving, and perform worse than non-users. In terms of demographics, they are relatively inexperienced, younger, and more likely to be males. Right? So clearly, you can see that there's a lot of differences between those who adopt this technology versus those who do not adopt this technology. So simple comparisons of adopters to non-adopters is going to suffer from selection, right? And so our data is going to allow us to then account for this selection by exploiting within individual time variation. So essentially our regression specification formally is going to look like this, where essentially I stands for an individual, J is the platform that they are using, and T is going to be the month. And again, because this is a trade level data, we are able to include investor by time fixed effects and able to derive variation or use variation within the same individual and within the same month. So we look at three different types of outcomes. We look at risk-taking and then gambling behavior, and then we look at biases. I'm going to skip reasons for why smartphones may affect risk-taking. But before I do that, I just want to highlight that there are reasons to believe that it could both positively or negatively affect risk-taking. And we find evidence consistent with smartphones actually facilitating risk-taking, right? So volatility of the assets purchased is one of our measures, where essentially we find that the economic magnitude for this measure ranges anywhere between 33.4% to 48.2% of the unconditional mean, depending on the exact type of specification we use, right? So there are four columns here. The outcome variable is volatility of the assets purchased. So throughout the paper, we'll only be looking at purchases. We begin by showing correlations without including any fixed effect. Then we include both individual and year fixed effects separately, and then we include individual by time, specifically individual by year and individual by month. Right? So I guess the differences in coefficients suggest that including individual by month fixed effects is actually important. And if we don't include anything, this was actually overestimating the effects that this particular technology was having on volatility of the assets purchased. Then we also look at gambling behavior. And the idea here is that smartphones essentially might lead to preferences for skewness and lottery type assets. So if you think about what a smartphone is doing, essentially the smartphone might be facilitating more system one, more intuitive type reasoning, which is associated with a higher preference for lotteries, right? So it follows that if a similar thing is going on with the smartphone as it is with system one, then we might expect to find that smartphones facilitate gambling behavior. And consistent with this theory, we do find that smartphones lead to greater gambling behavior. One of our measures is the skewness of the assets purchased, where we find that essentially individuals are more likely to purchase assets with higher skewness. So I guess I'll be focusing more on the final column, which is our most stringent specification. Even if we look at a broader definition, so following Kumar's paper, where essentially we look at assets with lower prices but higher volatility and higher skewness, as those assets who are lottery type assets, we find similar results where essentially investors are more likely to exhibit gambling behavior. Our last set of outcomes relate to biases.
5 more minutes.
Thanks. And previous studies have shown that technology could essentially lead to a decline in investment biases. Alternatively, it could also lead to an increase in biases, right? So I guess this is just to say that there is a possibility that it could go both ways, but we find evidence consistent with the latter, where essentially we look at 3 different types of biases. Under diversification, probability of purchasing past winners and past losers. And across the 3, we find that the tendency increases amongst the investors or amongst the trades done on smartphone by the same investor within the same month. So essentially, these trades are more likely to be under diversified. These trades are more likely to be past winners, and we also find similar results if we look at past losers. The spillover effects here are going to be important because this is again something that I have mentioned in my motivation, that it's possible that perhaps individuals are substituting trades across different platforms. And so to examine whether or not, or the relevance of this in our setting, we essentially look at the effect on non-smartphone trades for smartphone users. So essentially what we do is we run a different analysis where we look at staggered introduction of the app. So essentially we are comparing iOS users who were first able to use the smartphone app to non-iOS users who will, or to Android users who will be able to use it in the future, but we compare their non-smartphone trades. So essentially these regressions are done at the individual month level instead of the individual device month level. And what we find here is that we find no evidence consistent with substitution effects. If anything, there is evidence consistent with positive spillover effects, which would essentially suggest that investors are learning some behavior from smartphones and then carrying that behavior over to other platforms. I'm going to skip this in the interest of time. Next, we examine what mechanisms might be driving our results. And so what we find, the first thing that we examine is whether the timing of the trade and asset class selection matters for the results. So essentially, when we rerun our baseline analysis after including trade by time or asset class by time fixed effects, we find attenuated results, but qualitatively similar, which would suggest that both these aspects drive our results, but do not completely explain those. We also find that our results are stronger during after hours, which would suggest that, which would support the system 1 type of trades that smartphones facilitate system 1 trading. We are able to rule out that digital nudges might be driving our results. And finally, we find that our effects are not short-lived. They last for at least 6 years. So I'll take the last minute or two to just talk about the implications and to conclude. So one of the implications that we look at is the impact on performance. So essentially, we assume different holding periods. So essentially, after purchasing, whether you are holding it for 1 month, the asset for 1 month versus 3 months versus 6 months versus 12 months. And across all 4 aspects, we find that the Sharpe ratio for the assets purchased on smartphones are lower than the Sharpe ratio for the assets purchased on other platforms. Even if you look at the distribution seems to have moved towards the left. So it's not just about the mean. And the final implication that we look at is the heterogeneity in RFX across new and old investors. And so essentially what we find is that our results are stronger for those investors who had joined the bank at a later point. So essentially who are new investors, which would suggest that perhaps the estimates that I've shown are a lower bound for the Robinhood types of investors. So to conclude, we show that we use an analysis where we compare trades within the same individual and month, and show that those trades done using smartphones are likely to be riskier and lottery type assets. They are also more likely to be non-diversifying assets and past winners and losers. Investors do not offset these trades by substituting across platforms, and this has implications for both their performance and for inexperienced investors, which essentially cautions against the indiscriminate use of smartphones to increase access to financial markets. Thank you so much for your attention, and we really look forward to Steve's comments.
Thank you, Ankit. So our discussant is Steve Dimmock from National University of Singapore. Steve, you have 15 minutes.
Sorry, thanks. So it's a very interesting paper. I'm Steve Dimmock. I'll be discussing it. It's a very quick summary. There's two German banks. They introduced smartphone trading apps, and the banks introduced apps at different time, and there's within bank difference in the introduction for Apple versus Android, so there's variation based on the operating system. And the main punchline is investors who use the app, they buy riskier, more positively skewed securities. It just looks a lot like they're gambling with their trades rather than making sort of well-diversified, boring, but sensible investment decisions. And there's just nothing there to suggest that things improve. Their performance is worse and they're taking on more risk. There's no evidence they offset any of this by trading on other platforms. So even for the people who use smartphone apps, a lot of their trading is still done in traditional ways through online trading. And I think the results really are very consistent with smartphone trading, just enabling people to behave impulsively. That's my read on the paper. So that is an extremely fast summary of the paper, and I'm missing a great deal of detail there. In terms of the contribution, this paper is kind of very similar to things really almost a generation ago when online trading came along. And I think that's fine. I think even if this paper was exactly a replica of the online trading papers, but just did it with smartphones, that's perfectly okay. It's a different technology. It's worth seeing how this affects trading. But it's not just a pure replica. I think there are important differences, and there are multiple advantages. I'm just focusing on two here, so hopefully the authors don't feel I'm shortchanging them. There are other advantages of this setting and other things they do that are different. One thing that's nice is it's kind of cleaner data, and there's more ability to address the selection issues, which I think is important. If you look at why do people change trading platforms, the finding is sort of people have good experience, they have good returns. It's probably random luck that made them have good returns, but they then start to trade much more aggressively and they trade platforms. And so does a platform change, a switch from traditional trading to online trading, does that sort of causally change how people are trading, or is it just it's a flag for identifying people who are intending to change how they trade? This paper has much more ability to address that selection bias, and that selection bias is clearly, it's large and it's important. The other thing I think is important is it allows us to kind of break down what's meant by technology. So technology has many, many dimensions. I think the two most relevant here are sort of the ability to trade very quickly and impulsively, and also the ability to access information and potentially advice. And I think the paper kind of gets at this, but somewhat indirectly. One of the things with internet trading was that it was clearly a very large positive shock to both dimensions. With online trading, people could trade much more quickly and easily than before, but also there was just a massive change in the ability to access information. That was a very large change there. Smartphones make it a lot easier to trade impulsively. I mean, you can just be driving down the street, you see a long lineup at a donut shop, then the next red light, you pull out your phone and buy shares in that donut shop, right? Like it's sort of very easy to act impulsively. You can argue that it increases information or sort of access to information, but I'm skeptical that it does that in a very meaningful way. I think there are other kind of smartphone apps. Like if you look at the robo-advisor papers, smartphone robo-advisors, I see those papers as much more about ability to access information or sort of advice. This is much more about the ability to act impulsively. And so there's sort of an ability to separate these things. And this is important. If you go back to the online trading literature, a lot of the interpretations of why people were trading more aggressively when online trading came along, they weren't just about there's sort of the possibility of impulsive trading, but also it's a reaction to information and the additional flow of information. That's what changed the behavior. I see these results as kind of much more consistent with the impulsivity and much less with the access to information. And I think that's kind of an important distinction. And I think there is discussion of that in the paper, but it's somewhat indirect. I want to talk a bit about the main specification. So the main specification, you have some kind of a trade level characteristic. So it's an investor, a specific security in a month. And did they do that trade using a smartphone and then knock out investor month? And main finding is if smartphone variable equals 1 instead of 0, whatever characteristic you have right here, that characteristic is going to be just more kind of impulsive gambling lottery type of trade. Big advantage of including this fixed effect here is that it removes a lot of the confounding variation. So, someone becomes unemployed, their trading changes. Someone inherits a lot of money, their trading changes. That's knocked out completely. It's still kind of an endogenous choice within investor month, whether they choose to use the smartphone. So for a given investor in a given month, sort of holding still everything that's going on, they can choose to do some trades through the smartphone, some trades through traditional platforms. So this specification doesn't completely get around the selection issue. And then also, you avoid all of the confounding problems with time series changes and things like that by putting in an investor month fixed effect. But it's difficult to kind of infer the overall change. Sort of within portfolio, the riskier, more gambling type trades are executed on a smartphone, but it doesn't tell you as much about the aggregate change in the investor's overall portfolio and overall behavior when smartphone trading becomes possible. Now, the paper is very aware of this, and what they show, I think this is exactly I'm putting up the exact same two equations that were in the presentation. If you aggregate to the investor month, so the unit of observation has changed, put in smartphone launch. So this is the point in time in which an investor, given the bank they're at and given the operating system they use, they're able to use smartphone. It's not that they are using smartphone, it's that they're able to use smartphone. It gets around the selection issue. And then this is just a fairly standard diff and diff. The sample here is non-smartphone trades. And so the sample is just looking at what they do in the non-smartphone part of their portfolio. And the main thing is there's no offsetting in the non-smartphone part of the sample. And so if you see within investor month, there's a whole lot more trading that's sort of risky going on with the smartphones. And at the same time, there's no offsetting. You can combine those two pieces of information and sort of back out that at the sort of aggregate level, there is a change in investor behavior. But I find that kind of a fairly indirect way of getting around the issues to sort of first show it at the trade level and then sort of back out that it's not being offset in the way that would be necessary for the biases to be driving the result. I think it'd be a lot simpler and just more straightforward for the reader if you just ran basically this exact same regression, but just have the dependent variable right here, the characteristics of the entire portfolio, both smartphone and non-smartphone trades. That gets you, using the smartphone launch, that gets you completely around the selection issue. And because you've moved up to a more aggregated level, you do lose some of the clean identification. And so I'm not suggesting a wholesale replacement of the earlier specification, but I think to me this would be very informative, and to me it would be the cleanest way to show the aggregate change in the investor's portfolio. So that's one comment. One other thing, paper examines purchases only. And there's a reason for that. It's just that people can buy some shares of a company with a smartphone app, then buy some more shares online, and then sell shares using, sell half their shares using a smartphone, and then a week later, half their shares online. Like, it's sort of difficult to reconstruct sort of clean smartphone-only trading and non-smartphone trading. But I think there's a lot of information loss by not looking at sales as well. And at the trading level, there's not that information loss, but if you want to go up to kind of welfare or asset pricing implications, looking at the sales as well becomes very important. So you can kind of imagine sort of two extreme possibilities, that online or sort of app trading comes along and investors, you see a lot more purchasing of lottery type stocks or gambling type investments. Now, it could be that overall the portfolio, say it used to be 50% index funds and 50% undiversified bets on small high-tech companies. And the proportion of the portfolio allocated to these lottery type purchases increases. And you're seeing a lot more purchases, but you're seeing sort of a shift in the allocations. But it could be that the person keeps the same overall allocations, but they're basically just churning the lottery stock part of their portfolio much more rapidly. So say before smartphones come along, it's 50% index funds, 50% of the portfolio is in, say, a single high-tech small company. They could keep that, those portfolio allocations, but just instead of, say, a 2-month average holding period, it's a 2-week average holding period. So there's a lot more purchases, a lot more churn. Or it could be that they now have only a very small allocation to index funds and a very large allocation to lottery stocks. The welfare and asset pricing implications are quite different in these cases, because if you keep the allocations the same, that's not going to increase aggregate demand. There's a lot more purchases, but there's also a lot more sales, and the larger amount of sales is going to largely offset the asset pricing effect of the higher purchases. Whereas if there's an increase in allocation to these kind of securities, then you're going to see sort of an increase in net demand, which is going to affect prices. It's also going to matter for the investor welfare, because if they're just churning a lot more, then they're burning a lot of money in transaction costs. But at any given point in time, the penalty they're paying for under diversification is not very different. Whereas if there's an increase in the allocation, the sort of penalty they pay by having a much worse diversified portfolio, just unnecessarily holding unsystematic risk, that becomes worse. And so I think it would be useful to separate these things out and sort of look at the net effects, purchases and sales. And I think to do that, you probably have to go up to the investor month level. And so there would be a bit of a sacrifice in terms of identification, but you could make sort of stronger statements about asset pricing or welfare. If you sort of look at the justification, like there are people who are in the smartphone financial app business who talk about how wonderful smartphone apps are, and their main sort of, they talk about democratization of finance or inclusion, things like that. And the argument is you bring people into the investment ecosystem. I think your old and new investor tests get at this a little bit. And this may be outside the scope of your current paper, but I think you'd have the ability to sort of look explicitly just at new entrants, like just every month who wasn't in the system, they weren't trading at all, and then they're coming in. If you could, and I have no idea if you have the data for this, but if you could identify the bank's sort of pure retail banking clients who are not also investment clients, so people who just have, just a checking account, they're not investment clients, and then you can sort of see those people, they're the natural pool of non-participants who could switch to participants. And is it the case that when you introduce the apps, you see more of these kind of people who were not investors, they were non-participants being brought into the system? And there is kind of a range of behavior where people are trading aggressively, they're buying lottery type stocks. That's not a good thing. It's suboptimal relative to just holding a low-cost index fund. But it's possible to do things that are suboptimal, conditional on being an investor, that's still better than being a non-participant, right? So you can hold an imperfectly diversified portfolio and still be better off than if you had no portfolio at all. And so this would sort of get a bit at the bright side of the apps. I'm really skeptical that the bright side of the apps is large enough to offset the worst trading, but it would kind of get at the potential benefit of these apps. And again, this may be outside the scope of the current paper. This may be something that is quite a different question. Just a couple other. Yeah. Okay, I'm right on time then. Just a couple other small comments. For me, reading this paper, the most surprising, I guess, regression that was in the paper was about trading volume. I think that if the story is about impulsivity, that system one type thinking, I think it's sort of a very natural hypothesis is that when smartphones come along, people increase their trading volume, that they just trade more frequently, they churn their portfolio more. And I think that's very consistent with this kind of impulsivity story. This is sort of a small thing, but for me, it'd actually be easier if there were just, even just some screenshots of what the app looks like, what online trading looks like, and especially sort of a comparison of what information is available and what things look like comparing the smartphone versus online trading. So just sort of what do the two platforms going to have different access to advice from the brokerage side of things, different access to security information. And one thing I think it'd be kind of useful just in terms of motivating the paper is if you could just get a sense of from thinking, hey, I want to trade, to, opening up your computer, turning it on, going through the system for an online trade, how long does that take roughly? And then for the smartphone app, how long does it take roughly to get through a trade? Just to get a sense of sort of how much more quickly and simply you can trade. And I think the smartphone is going to be faster. And that's going to be in addition, obviously, to the fact that with a smartphone trade, you can execute it anywhere. Whereas with a online trade, it's sort of more difficult if you're just out and about doing something. So that, I think I'm right about on time. I think this is a very interesting and topical paper. And it's one where I really believe the punchline. Like I 100% believe that the introduction of the smartphone app results in more impulsive trading. And I think it is kind of very interesting. And I think that this, one of the things that's maybe most interesting to me is that I do see this as kind of splitting some of the different dimensions of technology apart. And that's something that I think you actually could push harder in the paper and in terms of the contribution. So I'm done. Thank you.
Thank you, Steve. So Ankit, you want to respond?
Sure. Thank you. Thank you so much, Steve. That was a fascinating discussion. Before I forget or before I begin, can I just request whenever you have a chance, please do share the slides with us.
Of course.
It would be super helpful. So I think I would like to begin by just saying that all your points are very well taken. And to be honest, some of those points are points that we discussed a lot and we've been back and forth about those. So I would just touch up on a couple. So the first thing, I agree with you that I think showing aggregate effects would be cool. I think one thing that the aggregate effects would perhaps lose is if there's like learning going on, if there's like a positive spillover effect going on for which we do find some evidence. We won't be able to capture that with the aggregate effects, but I think it's a really good suggestion to add it on top of what we have right now so that we have like within an individual month and then non-smartphone individual month and then just the total aggregate effect. I agree that we won't have to then make this implication based on the two results and just directly show that. About looking at only purchases, and this is the one that we thought a lot about, and I think the reason that we were a little bit reluctant, and you actually did point out, is that we won't be able to know what fraction of the stocks is purchased in one versus the other. So we would have to make some sort of assumption on like whether it's first in, first out, or last in, first out. Like we'll have to make some sort of assumption on how the flow happens in terms of coming in and going out. And so I guess this is definitely something that we should give a little bit more thought about. And then one thing about the info related to the app. So I think unfortunately we can only provide how the smartphone app looks like right now, but historically how it has looked and how it has evolved is something that we have tried to get at, but have not yet been able to get that data. We also looked at like the number of new entrants. It seems like they were like, I guess there were very few. So the number of entrants that came in after the smartphone app was launched was as few that we were not even able to like split the sample into new entrants, those who entered after the smartphone app versus those who entered before the app. So it seems that perhaps app is not the selling feature. Like these are like traditional banks, so it's not like a Robinhood type of an app where people would come in to use the app to trade. But again, I think all points are really well taken. We'll definitely take them very seriously and implement them as much as possible. And really appreciate your comments. Thanks a lot.
Thank you. So if the audience have any questions, please type the message or simply unmute to raise questions.
Hi.
Here, Roger.
Yeah, I'm thinking, I guess the limitation that is you actually cannot force someone to adopt, right? So all these adoptions are by choice. They choose to use the smartphone to trade, right? So you can't really separate whether the smartphone facilitates this kind of impulsive behavior or the smartphone actually causes the impulsive behavior.
But yeah, keep going.
So I thought, I mean, I don't have any test to solve this problem, but one thing I thought was maybe the smartphone allows you to trade much more quickly. So suppose there's an earnings announcement at 3 p.m. Then without the smartphone, you can only trade when you get home. But with the smartphone, you can trade immediately within 20 minutes. Right? So if you have the time of the trade, then you could see the manner which by the smartphone facilitates this sort of trading. Right? So I just wonder whether you have this sort of test or not.
Right. Yeah. So I think, I guess that's the point of having like the investor by month fixed effects, or perhaps maybe I'm missing something that you're suggesting. So I guess if I think about selection, so let's say I'm a special type of investor and I'm going through some other behavioral change because of which I want to trade, let's say, riskier assets, and that's why I use smartphone trades for that, right? So the investor by month fixed effects is then going to subsume these alternatives because it's going to be looking at my trade in the same month done on the smartphone versus on the other platforms. So even though my choice to use the smartphone in the first place was endogenous, the comparison that happens after controlling for that endogenous choice, because the comparison is happening within my own trades, right? So in that sense, it seems that we should be able to conclude that smartphones are leading to more of these biases. But perhaps if you think I'm missing something.
The difference is that it facilitates the trade rather than cause it, right? So maybe if I wanted to do this sort of kind of impulsive trading already, but the smartphone enables me to do it. It doesn't. I guess you have a statement saying that increasing the preferences for skewness and lottery-like stocks in slide 17, but maybe the preference for skewness and lottery-like stocks was already there in the first place, but the smartphone enables it, right? So it's very different from saying that it causes the lottery preference to suddenly appear.
I think this is where the smartphone launch with the different apps is useful, right? Like I think that sort of is a valid kind of instrument for selection.
But even in that case, like if you're on Android, then you could start using the app, but if you're on Apple, you couldn't. But that introduction doesn't cause the lottery preference to appear, right?
Yeah,
so it's quite different too.
Yeah.
Can you tell the difference between a limit order and a market order in these trades?
I believe we can. Yes, we have not used it for any of our tests, but I believe we can. Do you have anything specific?
No, then some of these could be liquidity demanding, right? So if they are impulsive, they might not be doing a limit order and just wait. You just go with the market order, right? So, and that could also be you're willing to make a price concession because you get immediacy.
Right. Right. So then the idea would be that these impulses should be more, or should be highlighted more for market orders than for limit orders.
Right.
Yeah, that's a good suggestion. Yeah, we can definitely look into that.
Ankit, may I just
yes, please go ahead.
Following up, piggyback on what Roger was asking. So Roger, it's not obvious to me why, if you have a preference for lottery type, why should you show these when you trade on your smartphone, while more so than when you trade on your desktop in the same month?
Well, I mean, think of the earnings announcement, right? Suppose the earnings announcement on Friday at 3 p.m. Then if I trade on a desktop, I know my ability to trade at short frequency is much less. I cannot respond to news that is coming out on Thursday and Friday, so I'm unlikely to do it, right? But now that I have a smartphone, I know I can trade at a very volatile time period. Then I'm more likely to participate in this sort of like lottery episode, right? So then
we do have evidence in the paper where we show that you are no more likely to trade at specific hours. And so there is not just a mere timing of the day effect. But what I'm just thinking is your concern that the investor by month fixed effect is not granular enough to capture this? Because, if you think that I have a preference for lottery, why would a preference for lottery be different if I trade on a smartphone versus on a desktop? Because that's what our identification is coming from. We're comparing the same investor within the same time period trading across platform. So if you have a preference for riskier stock, it shouldn't be affected by the platform that you choose.
Yeah, besides the time, I cannot think of anything else, right? So maybe in terms of timing, that's what the smartphone offers. But I agree that besides the timing, I'm not sure what else would cause the difference.
Okay. So we do have a result where if we do control for timing, we do find qualitatively similar effects.
Yeah, which is to me a bit puzzling, right? So then what else does the smartphone offer? Maybe just more exciting interface, or you feel more in control, like the online versus calling your broker stuff. But then, what is the mechanism, right? It's like sensation seeking, or I don't know, maybe just more excitement, more graphics, or. But they do trade. You showed they trade 10 times, right?
Yeah, I also see a hand from Massimo. Massimo, you want to also?
No, just a quick question. Do you have data on the cancellation of the order?
On the cancellation of the order?
Yes.
Yes, we do have data on that.
And do you have any information from that? Do you get that this iPhone, mobile phone changes the regret of the investor coming back home and cancel the order or no?
So if I make an order and then I cancel it,
yes,
we haven't looked at it. Yeah, we can. I think we can potentially look at it.
Because that would give me interest in terms of regret or time to think it over and cancel.
Yeah. We can definitely look at this.
Okay, so this is a great discussion. Actually, we have a break for the broad audience. So we will come back at 10:15 to continue our third paper. Meanwhile, if you want to discuss still on this platform, I think you can still discuss. For the rest of the guys, I will see you in a few minutes, 10 minutes.
Steve, thanks very much for your discussion. It was very helpful and insightful.
Yeah, no, I like the paper a lot. I think it's good. I think the technology, like there's some smart, like sort of smartphone app papers that say, here's some good outcomes. Here's some smartphone papers that say bad outcomes. And I think kind of what breaks those apart really is sort of, is it an advice, robo-advising kind of smartphone app, or is it a make it really easy to trade impulsivity type of app? I think that's kind of the way to break technology down. I think you agree with that, but I think you're very cautious on making the sort of shutting down the information channel. I don't know if I've ever sort of in a discussion before thought the authors were too cautious in claims, but I think you actually could push harder on that.
That's always a great thing to hear from a discussant, that we are too cautious on the claims. I think you're right. I think just because there is evidence out there on some of these other types of apps and how they facilitate information, I think that's why we've been a little bit reluctant not to press on.
Maybe advice is a better term than information for the other sort of the positive effect of smartphone app papers. I think that is kind of the distinction between things that seem to have benefits and things that just cause harm.
Yep. And getting back to a couple of your suggestions, one of the two banks agreed to extend the data up to now. And so definitely they would allow us to look at the inclusion question, because part of the reason also why we do not observe, it's a sampling issue in terms of how many new clients we get, but that would be just the universe of all the smartphone users. And another thing we have on our request list, which we are very interested to investigate, is the time to pull the trigger, if you wish. Something like try to measure how long does it take you when you are on your desktop to log in and then execute the trade, and how long does it take you when you are on your smartphone. And I think the prediction is that your smartphone will be way faster.
Yeah. And I think it doesn't need to be that precise. It's more just sort of a motivating back of the envelope. If you had access to this and you just click through and timed yourself, it's sort of roughly how long does it take? It's because I think it should be faster. It's more just sort of, I think the two ways that it enables a sort of impulsive trading is you can trade anywhere. It's much easier to be having, a conversation you're not really paying attention to on the phone and trading simultaneously. I think with a smartphone than with a computer.
I totally agree. Yeah.
So I thought one of the stuff that Barbara and Odin, the slow die first paper, was that online trading causes you to feel that you are in control, compared to calling your broker and ask him or her to execute a trade. When you actually do it yourself online, you feel kind of you're in control, right? So maybe the smartphone brings it to another level. So I think Bob Schiller in one of the survey articles talk about quasi-magical thinking. So suppose you throw the dice yourself, you're willing to place a higher bet than if someone else throws the dice. Of course, the probability is no different, right? So maybe smartphone allows you to move from in one level up. You actually feel much more in control with the stuff in your hand and with your fingers doing it rather than clicking with a mouse.
So there is some interesting evidence that comes from marketing that they show that when people do trades on smartphone, they tend to do this in a very instinctive way, in a very system one type of way. Emotional rooms stronger and larger in their effects. And I think that's kind of showing that this happens too when you're trading. There is evidence that people tend to order more unhealthy food when they order using smartphones. There is evidence that people tend to buy more unnecessary items when they do shopping using smartphones. I think it's this whole idea that we are used to use smartphone just as a fun device, and then maybe our brain doesn't get used to associate the fact that with smartphone now you can trade literally thousands and thousands of dollars with one click, right? Maybe the most expensive thing we would do with one click was buying, a grocery, buy groceries or buying a movie ticket.
Yeah, interesting stuff.
Thanks, Roger. Thanks for your comments.